I am going to somewhat turn this over to Henry. I just want to give you a little bit more on Henry's background, and then maybe Henry can just kind of give us a little backdrop about what he wants to talk about tonight, and then maybe I'll shoot you a couple of questions. And again, speaking of questions, I just want to again remind everybody about the question pod on the right-hand corner. But Henry, you see Henry's information there, and it's going to stay on the screen for a little bit, so you need to jot his phone number, his email, website, and this presentation is being recorded, so it will be on our website in a couple of weeks. So if you need to, if you miss something, you want to get Henry's information, it'll be up on the website. But Henry has over 30 years experience in helping clients secure their professional and personal financial futures with his expert advice on insurance and taxation, retirement planning. And one of Henry's most demanded specialties in recent years is educating clients and their advisors about preventing the threat of premature expiration of individually or trust-owned life insurance. Henry even has recently co-authored a book for the American Bar Association on the topic of life insurance. So that's how important this topic is. The American Bar Association is a pretty big organization, and they reached out to Henry to help co-author a book partly about this problem.
Thank you very much, Rick. What I've been doing over the last few years is writing about a problem that developed in the early 1980s. And before I tell you what I do and share that with the audience, let me just give you a little bit of a background, a little bit of a history. Yeah. If I can take everybody back to the early 1980s, everybody remember President Reagan was in office, the Iranian hostage crisis first began, interest rates were 20, 18, 19, 20%. Back then, bringing it back down to the insurance world, there were only two types of insurance products. One was a term insurance, which lasted for 5 years, 10 years, 15 or 20 years, and it was guaranteed to last for that time period. And the other was whole life insurance. Now, term insurance was like renting an apartment. It had no value, whereas whole life insurance had some cash value. Well, back in those days, the cash value in a whole life insurance contract was paying roughly 3 or 4%. So here were people who for years had been putting away money into a whole life insurance contract, and they had 30, 40, 50, 100, 200, several $100,000, and they were earning 3%. And yet here they were looking at their favorite bank who was offering to pay them 18 or 19 or 20% in 1982. And by the way, in addition to giving them that exorbitant interest rate, if you remember, the toaster. How many times did people just bring their money from one bank to the other because they liked the toaster that was being given out? Well, between the 18, 19% and the toaster, it was no match for the cash value that was sitting in the 3, 4% cash value with insurance companies. So naturally, smart people began moving their money from the cash value of the insurance industry into the banks. Now, the insurance industry is by no means a stupid industry, and they responded in kind. What they did, very simply, is they said, well, everyone wants a high current interest rate. We're going to create another line of product, something called universal life insurance. And if the current interest rate is 18, 19, 20%, we're going to pay that. But if interest rates go down, we're going to pay the reduced rate. If interest rates go up, we're going to pay more, just like the banks. Well, they went ahead and they did this. The only problem was that they didn't really concentrate, and people didn't really know to ask the questions about, what do you mean this product isn't guaranteed? So while everyone was concentrating on what they were getting as far as interest rates and whether they were getting the General Electric or some other toaster, no one really paid any attention or concentrated on the fact that these insurance products were not guaranteed. Now, as we all know, over the last few years, over the last 20 years, as a matter of fact, interest rates have gone straight down. And herein lies the problem. No one went back to the insured. No one went to the owner of that contract, who most often was the eldest son or daughter. No one went back to the advisor. No one told anyone that, by the way, as interest rates drop, you've got to pay more money to the insurance company to make up for their lost earnings. Well, that created, as you can appreciate, a problem, because all of a sudden you had people who weren't aware that they were now 100% responsible for the performance of their life insurance contract. And as I say, as interest rates declined, the variable, what began happening, is that people continued to receive the bill for the same premium, for the same death benefit, but to make up for the fact that the insurance company was earning less money, the insurance company reduced the amount of time that the insurance policy would stay in force for. Now, that, as you can imagine, created a huge problem of people not receiving their monies that their parents had left for them. Most of the people who were responsible for this were the trustees. These were the eldest sons and daughters who were serving at the pleasure of their parent, and it was quite an honor to be a trustee. But unfortunately, these individuals are now being sued by their other siblings because they allowed their insurance contract to expire prematurely on a technicality. And everyone is blaming everyone else. And I guess one of the reasons that the American Bar Association stepped up, and as you know, Frank, I have written a couple of other articles for the New York State Bar Association and various other professional organizations. Everyone's concerned that the advisors are going to somehow get blamed for this with all this finger pointing. So there's information that we need to be able to provide for a client. And some of those evaluations that we do, and now I'm getting into the actual work that we do, is we provide performance evaluations for clients' families, just like yours, to make sure that the life insurance inheritance doesn't expire prematurely, that family members are not sued, that, you know, recently there have been new benefits in various insurance contracts as a result of the 2006 Pension Protection Act, which became effective January 1st of 2010, and products became available in 2011. Many insurance contracts nowadays provide access to be able to obtain long-term nursing care insurance or chronic care insurance actually from the death benefit of the insurance policy on a tax-free basis. Now that's significant. So we try to make sure that those current benefits are available in today's contracts, that they're in line with a current objective that the individual has today. Oftentimes these insurance contracts were taken out 10, 15, 20, 30 years ago, and times have changed. Things have changed, objectives have changed, and most importantly, that they get the most dollar based on today's value. So in other words, we're trying to speak to the independent, experienced life insurance. I'm trying to get you to speak to an independent life insurance professional who specializes in these areas and who can open the door to let you see exactly where you are, to basically what I like to call reintroducing someone to their own life insurance portfolio. So I've said a mouthful, but let me just stop on this note. Before 1982, life insurance used to be what I call a buy and hold asset. You bought it, you put it in your bottom left-hand drawer because you didn't like talking about it, you didn't understand it, and oftentimes you didn't even trust the person that was selling it to you. So you put it away, and life insurance today is no longer a buy and hold asset. Life insurance today has to be a buy and manage asset, just like you would with your real estate portfolio, your stock, and your bond portfolio. I got to take a breath for a second and just let you come in and just ask me a question.
Well, yeah, so I guess a couple of things. One, when we talk about the insurance expire before, you know, those ones that kind of leave and don't your life insurance expire before you. So how does that happen? How does it actually expire? That's because the rates, like you talked about before?
Yeah, it's two things. It's the reduced interest rates over the last 20 plus years, and it's the inattention on the part of the owners of the policies. As I mentioned, oftentimes the sons and the daughters who are acting as the unskilled trustees. They keep getting the same bills from the insurance company, and they keep paying them. But those bills were predicated, if somebody bought this in the early 1980s, those bills were predicated on the insurance industry earning 18, 19, 17, 15%. Well, obviously those rates haven't occurred. And it's the inattention over those years that are resulting in the same premium buying the same amount of coverage only for a shorter duration of time.
Okay. And you mentioned the kids as trustees, so I guess you're talking about somebody who maybe set up a life insurance trust.
Yeah,
life insurance. Yeah,
sure.
Maybe just clarify because I'm not sure if everybody may have picked up on that.
Sure. Again, 20, 30 years ago, people, when the estate taxes were considerably lower
right,
than they are today at the $5 million level, people with $1 million worth of assets were putting their life insurance into trust or putting it into the name of adult children so that they wouldn't have to be stuck paying the federal estate as well as the state inheritance tax. So people would either give it directly to their sons and daughters, or they would give it to their sons and daughters acting as trustees for an ILIT, an irrevocable life insurance trust, which your office is extremely capable and knowledgeable in dealing with. But whether it was a private owner or whether it was a trustee in a irrevocable life insurance trust, the underlying asset funding this was the life insurance.
Right.
And people forgot to keep the eye on the ball, recognizing that life insurance is not guaranteed. And therein lies the problem. People were used to term insurance being guaranteed, lasting for as long as they thought it was going to be enforced for, and that was guaranteed. And the same thing with whole life. That was guaranteed as long as you paid your premium for the rest of your life. But here, you could pay the billed premium on time from the insurance company, but it turns out not being sufficient because of the reduced interest and the lack of attention over all of those years when the owners should have been paying a higher premium to make up for the loss in earnings because of the lower interest rates.
Right. So is there anything people can do to I don't know, fix the problem is the right word, or address the problem?
It's examine, yeah, and it's a great question. It's examine what they have. They've got to find out whether or not their contract is one of the 70% of contracts that were sold over the last 25 years that are not guaranteed. They've got to deal with an independent, experienced professional who specializes in these areas. Whether you go back to your own insurance advisor or whether you seek out a knowledgeable, experienced advisor, the point is to get in front, get your contract, get your portfolio in front of someone that can give you some advice. Just as you pointed out the wonderful things that an individual should know about Medicaid, the same holds true for life insurance, and a knowledgeable individual can look at it and determine immediately by requesting what's known as a historical projection. In other words, asking that insurance company to go back ever since they've had your insurance policy and tell you, based on the premium that you paid, based on the interest rate each year, how long your contract is going to last. And the sooner you find that out, the more options you're going to have.
Yeah, I mean, that's very well said. I mean, I think one of the biggest fears, I know it's one of my fears, is with insurance in general. You pay in, and you could get virtually nothing out of it.
It's a real problem. Right? It's a real problem. And if you wait and you first find out that there's a problem when you're 85 years old, you're not going to have very much time to make up that lost premium. Right. But if you're fortunate enough to have somebody bring this to your attention in your late 70s and your early 80s, when you still perhaps have 10 or 15 years to be able to adjust and make up the premium, it's more manageable. Right. But it breaks my heart when I see people who come to me with a premium that's 5, 6 times more than they've paid. And their kids and themselves have to make the hard decision. Do I pay a $10,000, $12,000 premium for $100,000? Well, sure, if the person is 85, 90 years old, you begin figuring it out. But right. What if the person has some health issues? What if the person is a little bit older? What if the person's a little bit younger? You've got to start dealing with questions where you're trying to save what you've already paid and weigh that against how much more money you might be throwing in and whether it's worth it. And oftentimes, as you said, Frank, people wind up losing their insurance in the analysis of trying to figure out what to do because they don't leave themselves enough time.
I was talking to somebody probably about a year or so ago. It might have even been Vincent Russo, who said that their father had gotten an insurance premium bill, and it had gone. It was not a huge amount of insurance, but the premium had gone from something like $5,000 or $6,000 a year to $22,000. What do you do with that? You know, like you said, you got to
look. The insurance industry is only responsible to send out an annual notice and to give you the information when you request it. But many insurance companies, if you look at that annual statement, if you actually look at it, which I encourage all of your clients to do, don't just put it away. But if you look at it, some of those policies will actually tell you exactly how much longer to the day that your insurance will last. The longer you have before that date, the more options you have to be able to reduce the premium, or, well, reduce the amount that you would have had to have paid. Of course, you're going to have to wind up paying more, but you at least have the ability of keeping your insurance. If they wait too long, then that option, it just becomes too expensive. And again, the insurance industry is very happy.
They're not losing money.
They're not losing sleep.
Money.
They're not losing money. They're doing just fine.
Yeah.
It's really up to the individual consumer to advocate for themselves. And again, that's what I know you do here. When somebody comes in, you really do a all-around thorough evaluation and analysis, which is very helpful.
Yeah, I think we try to look at the forest as opposed to the trees. You know, a lot of times people come in with kind of tunnel vision. And as you said, our job and your job as well is to advise. I mean, you know, we can't make decisions for people, but we can hopefully help them make the right decision for themselves.
Well, the answer to your question, Frank, is just making them aware of where they are and comparing what they have to what they could perhaps possibly be doing. Look, a person only has 5 choices. They can either increase the premium, they can decrease the death benefit. If they're healthy enough, they can take advantage of the fact that perhaps they may be able to qualify for one of the new insurance contracts, which, by the way, oftentimes are less expensive simply because Society of Actuaries is telling us that people living longer, and people living longer, then the cost of insurance decreases. Sometimes it's possible that the insurance that a person is buying today may very well be less expensive than the insurance that they bought many, many years ago. People today are considered non-smokers. 15, 20 years ago, they didn't have that category. If I can simply reduce someone's rate from a smoker to a non-smoker, I'd probably save them close to 15 or 20% of their insurance each and every year. So the third option is taking advantage, if they're healthy enough, to purchase perhaps a new contract at a lower cost, and also one that has those long-term care and chronic care benefits. The fourth option is if you can't pay the premiums and you shouldn't give up the policy without getting something for it, there's something called a life settlement, which is where an individual can sell their life insurance contract just like they can their house or their car. And option 5 is some combination of the other 4. So a person has to know where they are, and then they have to examine to see whether or not one of those 4 or 5 options might put them in a better position than they're currently in right now.